Welcome back to another day in the market, and if you are trading this market, you're going to want to stick around for the entirety of this video because I have something here that moving forward you're probably going to want to use pretty religiously. One, because it is pretty reliable, and two is because it has stood the test of time over many years. So what do we have here? Well, what's important to understand is there is a couple of things that determine a bear market or a bull market. One being macroeconomic news and environment, for example, inflation and the interest rates. Another example is seasonal rotation. We often understand that news will often follow the market and follow the stock price, not always vice versa. And that's really important because what good news or good earnings will do for a stock and a stock price in one market, a bull market, for example, will do completely the opposite or just nothing at all in a bear market. So one thing that is important to understand is, are we in a seasonal rotation of the S&P 500? Well, that's hard to determine because of one thing, the money supply, right? So if we look right here, we see the US money supply. There is constantly more money being pumped into our economy, being pumped into our system. That is why the Fed has a mandate of 2 to 3% of inflation, because there's constantly more money being put into the economy. And when it's put into the economy, it's put into the market. And when it's put into the market, it is put into the S&P 500 inevitably, right? So because of that, the S&P 500 by nature is skewed. And so one way to be able to look at seasonal rotation is to look at the S&P 500, the stock market as a whole, in relation to the money supply. Okay, so first, before we do that, I wanted to show you exactly what I mean. Okay, so we laid out right here for October of 2007. That was a high before the economic crash that led following in 2008. A lot of people like to say 2008, 2008, but really it started at the end of 2007, okay? So we had a high here, we had a peak here, 2007, and we crashed. We had a high right here of 114, and we crashed all the way down to, it was like, I gotta move myself here, all the way down to $50, okay? So that was huge. That's like more than 50%. Right here, got to zoom in a little bit. We are on the monthly, by the way, and that is 2018, January of 2018. I know there was a lot of talks about inflation and interest rates then. Actually, I don't know about inflation necessarily, but interest rates there, what the Fed was doing kind of scared a lot of people, things like that. I think because just the market was going so high. So that was actually a pretty significant drop as well, 258 down to 230. And actually really it reached a low of 216, so 258 to 230. And then in 2020, so February of 2020, we were 319, went all the way down to 207. And then here, now not quite the high, just barely not quite the high, but I'm going to show you why this candle is important right here. We were at about 459 and we reached all the way down to 344. And then we have a final dot right here, 459, and that is to be determined where we drop. So why did I mark these points? Well, you would probably be saying I marked these points because that is the beginning of that was the high point in the beginning of a low point. But that doesn't quite make sense because of this, right? How do I know that this is going to go down? Well, if we actually compare the S&P 500 to the money supply, and you factor in the money supply, there is a huge resistance here that has gone back all the way to 2007. And actually, you could put it back all the way to 2001, where we had that huge tech bubble right now, or back then. And you can see that we actually did continue to fall pretty significantly after that resistance. So you could even extend this little zone right here, this high zone right here, bring it all the way back over there. So I marked the same points of right here that I did right here. So you can see October of 2007, we fell. January of 2018, we fell. January of 2020, we fell. October of 2021, we fell. And look where we are now. We are right next to our previous high if you are counting the money supply for the S&P 500. So this is essentially the S&P 500, just to go over it one more time. This is essentially the S&P 500 with the increase of money into our economy as a factor. It's weighted based on the money supply. So that helps you see seasonally where we are at. Now, if we continue down to this downtrend, we could potentially see previous lows of where we were, which if you're going back to here, that could very easily be back to our previous lows that we had earlier last year, if not potentially even lower, because again, we have more money in our economy now, right? So it is one thing that is very important if you are going long on stocks right now. It is just very important to consider. I think moving forward, we're definitely going to pay huge attention to this because this is pretty significant. Now you got to play it on the monthly. I mean, I guess you could for any other sort of time frame, but it's really just important to look at it on the monthly to see where we're at. Now you can see one last thing here. As you can see, we kind of dipped around a little bit right here. And if you go to the S&P 500, this right here was a lot higher because it was months later and we had more money in the economy. And it did slightly reach almost a little bit higher there. So just dancing around right here can be pretty significant as far as gains, So that's all I got for you today. This is the S&P 500 with the money supply factored in. And if you like this video, please hit the like button. It's the easiest way to help out the channel. Otherwise, hit the subscription button and hit the notification bell so you can see all of my latest content. I really appreciate you watching. Have a good